All right, ladies and gentlemen, I hope you had a wonderful weekend. We have a very wild week ahead. It was already filled with data and earnings and all of these events, but then over the weekend, it is officially confirmed Joe Biden is stepping down from the presidential race and is no longer running as the Democratic candidate. So this is a very big deal because leading into this, as all the rumors were swirling around, everybody was asking what will happen if Joe Biden drops out. So as far as that reaction, we truthfully do not know, and we are going to find out tomorrow and even tonight in a couple of hours when the futures open. That's going to give us an idea of where things are headed. But for now, the current line of logic that we're following on, it's the last couple of weeks after the debate when the odds of Trump started going up, we started watching new trades emerge, and that is what relates to all of these possibilities now that Biden has officially dropped out. So the real big logic you got to be following into this week, it is the early Trump trade, and that revolved around a strong dollar, more inflation, more spending without any taxes, better industry updates and regulation for healthcare and crypto. They should benefit. Dirty fossil fuels should go up, and prison stocks, and then clean energy and China would get clobbered. These are all related to the Trump trades. The curve will steepen, the dollar will get stronger, and this is all because of his policies and tariffs and all of that. That's been something we have been responding to the last couple of weeks. So now that Biden dropped out, watch if any of these trades, if they keep getting ground or if they reverse. This will be the first thing we got to look for. And then now that Kamala will in fact be the replacement, we want to see pretty much what kind of marketing does she do, what sort of policies does she start putting forward, and as she starts to explain stuff, the odds of other trades, they will start to go up, and then literally those trades will move and will get traction depending upon each candidate's odds. So as Trump's odds go higher and lower, you'll watch those industries move, and then vice versa with Kamala. But for now, we don't know what's going to happen. My initial idea, a lot of people were asking me, I think that this would be bearish for the market, that Biden stepping down would have a short-term negative effect, and then once everybody gets their jitters out and then starts coming up with a plan of what's going to happen, they're like, oh, well, Trump's not that bad, or maybe Kamala's not that bad, and then the market will go back to it. But the fact of the matter is, we have our own little schedule we have to react to for this week, but now this news is absolutely huge, and this is going to cut out a lot of our work this week. So we still got a lot more to talk about. I have the recap, I have the plays, all that good stuff. What I need from you, a thumbs up on the video. Make sure you're subscribed, and if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. We will see you there in the morning. And today is Sunday, tomorrow is Monday. Don't forget about the random account generator. What we ask on this watch list, you post a random option trade, keep it below $100, and then tomorrow morning we're going to do a random comment picker and pick the play. So get some time, no debit spreads, no none of that, but just try to get some more time, make it a good play, and we'll see. I don't know what happened on Friday. I think we had an expiration. Did we have something? Yeah, I don't know, but run it, baby.
Working to the couch, it's the joints on the legs. Live in the hills, but still get a spread. Started with a live, but still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but the sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
All right, off the bat, like I said, this politics thing is going to muddy the waters this week. We already had quite the schedule, I believe, from Tuesday all the way down to Friday. You're going to be getting global PMIs from all the other countries, and then even the United States. We're going to get GDP data. There's going to be real estate data, PCE data, again, another inflation gauge there on Friday, and then the cherry on top, you're going to get a bunch of earnings. Literally by Tuesday, you'll be hearing from Tesla, Google, Alphabet, and a couple of these big-name companies, and I think this week and next week will be the two biggest weeks for earnings. So we had all of these events that we had to deal with, but now you are going to have to sprinkle on that politics, and I do think the first couple of days we need to see, does the Trump trade get legs? Do the probabilities move different industries? And do we see a bigger reaction to this historical political event, or does the market fall firmly back into earnings mode? So that's the first thing you got to watch out for. The other big thing you got to keep in mind, not only is this week important, but look at the calendar, look at the clock. We're talking liquidity, summer, all of these different things. Well, This is the final week until Powell. You have Powell next week, and you're also going to get a bunch of earnings. This week, we still get a lot of earnings, and if you think about last week, there was a big dynamic at play, and that was the rotation. Do you actually get the rotation to keep going? Do we still see that strength we saw last week in small caps, and then the tech sell off and chips do whatever, or do we watch that reverse, and does everybody kind of give up on that, and then we fall back into either following Powell or following earnings, or maybe everybody just panics for no reason? But the point is, you have 1 week to do a lot of action up until Powell, and then once we get Powell, we're going to be able to confirm everything. And then this week, we want to see, do you still get that Russell 2000 rotation or not? So watch out for that. That is key number 2. And then finally, the number 1 thing here, man, I'm glad I kept all of them up for you today, but in the midst of all of this last week and everything you saw, I hope you guys realize whether bonds are making a move, the dollar, the Chinese yuan, the Japanese yen, nobody is panicking anywhere around the world right now, and everybody is focusing on the next stage of policy and presidency. That's why with what's going on here with Biden, we got to see what happens as we get into it. Does it cause panic or not? Lately, it's been hard to get people from all over to panic. Everybody has just been following the next stages of policy and politics, and once again, that's where we are right now. So I'd watch out for that this week. Watch if anybody does get panicked. Other than that, though, I think it's just going to go get a little bit of action, a couple of bumps here and there, and before you know it, we're falling back in line, waiting for Powell, then waiting for the end of summer, then the September meeting. And that's something here too. I keep saying it because, like I'm saying, with what everybody's focusing on, if you don't know, those September odds of a rate cut, they're now at 100%. I was even talking about this before Biden stepped down. I think it's going to be very interesting this week because now with Biden stepping down, how do the politics factor into that? Are rate cut odds for September going to go up? But the point I'm saying is that these last couple of days here, those odds have been driving a lot of the market, and I've heard more people talk about when we're going to cut rates and cutting in September and talking about how we're going to cut for good reasons rather than being worried about anything, let alone even the presidency. So we'll see how it all unfolds, but it should be a very dramatic week when it's all said and done, and then it's going to lead us into a big Powell. And now, let us get into the plays. So, right off the bat, I got 3 different plays for tomorrow. There's actually a couple of other ones because there is a lot of earnings, so make sure you guys are there on stream. Make sure you like the video. We're going to be going over all of the earnings previews, but like I'm saying, this week, next week, there's going to be hundreds of them, so it's going to be hard to pick them out and put them all there. You definitely want to be there live, but I still have a couple of plays I will be eyeing, and I do like the pre-run-ups a little bit better. So to start with the first one, Snapchat, that's the one I added 1,000 shares on Thursday. I think I'm down 20 cents a share, $200, but I still like this pre-earnings play. Meta recovered a little bit there, so I'm hoping that they do good, and then we'll see. After the first one reports, I do think Meta might be ahead of Snapchat, but whichever one reports first, you'll get an idea and sentiment from there, and then the idea is to close the play before earnings. So watch out for that. That is play number 1. Then play number 2. This one I'm excited for. It was the only play I held from last week, and I am positioned a little higher. I think I'm in at 2,400 or 2,405 on gold, but I really like this with all the politics going on, but it's going to be a tough read. Again, if people do believe the Donald Trump trade means a stronger dollar, what's going to happen to gold? But then if they do believe he's going to spend and lead to inflation, what happens to gold? Gold has been at a very interesting spot because it gets to respond to our politics as well as what happens all around and all the central banks. So with big things going on and kind of unprecedented things like the president dropping out of the race, I think gold is going to be a great one to be looking for. So we'll see, but I don't know how it's going to play. So I will definitely be keeping a close eye out for that. So watch that. That is play number 2. And then finally, play number 3, SBUX. Elliott took a stake. This was later in the day on Friday. They took a stake in SBUX out of nowhere. It was literally hovering around that $72 level that it's been at. So I like this. I would just watch to see if it turns into anything. It may be a little slow, kind of like Southwest and Elliott. They just got into that, but it rocketed off of that $74 level. So we'll see how it is, or if it's shy even with the 72s, but it's on my radar. I don't have a play on it. We went with Nike instead, but I would definitely keep an eye out for this, especially if it turns into kind of like a Disney proxy war type beat where other people are getting involved, trying to take advantage of all of the value that some of these companies have. So those are the main plays. As far as everything else, I still got one more for you. Keep your eye on the value plays. Like I'm saying, the whole theme of what we dealt with last week, I still think it's important, and we want to see how that continues. Any of the rotations and value favorites like Altria, Pfizer, Intel, see how they all perform. I will definitely be keeping a close eye on all of those. But as far as everything else, I don't think, I only had the lessons. I did make a couple of plays on Friday. I went after a couple of like ES flips. We ended the stream early. There wasn't really much going on. I wanted to chill a little bit, but only made a couple of those trades. Ended up holding the gold and holding the snap, but nothing too crazy. But I do think I'll do a lot of what I did last week, flipping the bonds back and forth and all of that. I think there'll be some good opportunities, and if there's not, I would punt until we get to Powell next week, and that will provide us everything. But now, let's get to the lesson. So, Chattadonia, we are going to be starting Chapter 9 here, and this is going to be looking at, like, the politics. I don't know if that's the title. Yeah, it is called politics, but it's going to talk about the MNCs and now kind of how they get in the way of everything and the politics behind all of these companies trying to get involved in all these different territories. And then, again, you're pretty much either competing or working with the government, and that doesn't always lead to being a cakewalk. So, we'll see where it takes us. Remember, if I interrupt, that is my opinion. And we are 192 pages in. Isn't that wild? But here it is, Chapter 9, the politics of multinational corporations. In late 2013, a Chinese company purchased the American pork processing giant Smithfield Foods for $4.7 billion. The announcement of the deal sparked political backlash in the United States. Senator Debbie Stabenow, chair of the Senate Agriculture Committee, declared the food security is national security. She noted that she could not imagine that the American people will feel comfortable if they wake up one day to discover that half of our food processors are owned by China. She called a special hearing for the Senate Agriculture Committee to look more closely into the Smithfield Foods deal. During that hearing, many senators voiced concerns about how the Chinese acquisition might influence the safety of the American food supply moving forward, while others expressed concern about the long-run implications of the United States becoming dependent on China producers for its food. While the committee lacked the authority to block the deal, the hearing revealed that Chinese acquisitions of American businesses remained a politically sensitive issue. Sensitivity surrounding the Smithfield food deal is hardly unique. Indeed, since 2016, the U.S. government has become increasingly concerned about foreign investments in American firms that control critical technologies, with investment by Chinese firms attracting particular scrutiny. American concerns reflect the fact that MNCs alter the nature of the economic decision-making in ways that disconnect economic and political geography. Historically, decisions about production have been made by local business owners with reference to local conditions. When MNCs are involved, however, foreign managers make production decisions with reference to global conditions, yet whereas the frame of reference for much economic decision-making has shifted, the frame of reference for political decision-making has not. Governments continue to address local concerns in response to the demands of local interest groups. As one prominent scholar of MNCs has written, the regime of nation-states is built on the principle that the people in any national jurisdiction have a right to try to maximize their well-being as they define it within their jurisdiction. The MNC, on the other hand, is bent on maximizing the well-being of its stakeholders from global operations without accepting responsibility for the consequences of its actions in any individual national jurisdictions. Vernon, 1998. The tension inherent in these overlapping decisions-making frameworks shapes the domestic and international politics of MNCs. In the domestic arena, most governments have been unwilling to forego the potential benefits of foreign investment, yet few have been willing to allow foreign firms to operate without restriction. Consequently, most governments have used national regulations and have bargained with with individual MNCs to ensure that operations of foreign firms are consistent with national objectives. Government's efforts to regulate MNC activities carry out over in international politics. Host countries, especially in the developing world, pursue international rules to codify their rights to control the activities of foreign firms operating within their borders. Countries that serve as home bases for MNCs, essentially the advanced industrialized countries, pursue international rules that protect their overseas investments by limiting the ability of host countries to regulate the activity of MNCs. We examine these dynamics here. We first look at the variety of instrument governments have used to extract as many of the benefits from foreign direct investment as they could, while at the same time minimizing the perceived costs arising from allowing foreign firms to control local industries. We then focus our efforts, unsuccessful to date, to negotiate international rules defining the respective rights and obligations of host countries and MNCs. So they're pretty much just explaining the intro here and the politics of MNCs and just this idea of how governments, they want to benefit society as a whole. These corporations, they only want to benefit their shareholders. And then you get this back and forth decision-making process where one group is focused on the people and the jurisdiction where multinational corporations aren't. And now what has that created over this time? And then again, it's going to even talk about how it's led to certain lobbying and rules that to this day have not changed. And this dynamic between host countries where you are actually conducting the business and where the MNC has home base, you're going to see that come up a lot. But ideally, this is kind of some of the same theories or themes that we have gotten from the last chapter, but continuing, regulating multinational corporations rather than forego the potential benefits from hosting MNC affiliates. Most governments have sought to define the terms under which MNCs operate within their borders. Governments have regulated proscriptively and prescriptively. That is, they have prohibited foreign firms from engaging in certain activities, and they have required them to engage in others. All these regulations have been oriented towards the same goal, extracting as many benefits from FDI as possible, while simultaneously minimizing the costs associated with ceding decision-making authority to foreign firms. We look first at how developing countries attempt to regulate MNC activity, and then turn our attention to the practices common in the advanced industrialized economies. As we will see, even though both developed countries regulate MNC activities, developing countries have relied far more heavily on such practices. So if I could stop, one thing you've really got to understand, it's this idea of extracting benefits of FDI while not giving up decision making. And that's pretty much this whole dilemma we're talking about between governments and multinational corporations. Remember, all of these governments around the world, they want foreign direct investment, FDI. It allows you to have more savings than you would have all these other opportunities. You could grow and build out way faster than you would have if you were not getting foreigners literally giving you direct investment, building factories, all of that stuff. So these countries really like FDI, and they want it, and they want to get as much of it as they can. But the problem is that the more FDI and the more investment you take, you are giving up decision making to these corporations. And that's now the dilemma of saying, how do you get the most benefits while not giving up the most control? So continuing, thus we conclude this section by examining why the two groups of countries adopted such different approaches towards MNCs. So regulating multinational corporations in the developing world. In the early post-war period, most developing country governments viewed MNCs with considerable unease. The association of foreign companies with former colonial powers, their employment of expatriates in senior positions, their past history, real or imagined, of discrimination against local workers, and their embodiment of alien cultural values all contributed to the suspicion with which MNCs were regarded in developing countries. Jones, 1996. Governments in newly independent countries wanted to establish their political and economic autonomy from former colonial powers, and often this entailed taking control of existing foreign investments and managing them under which new investments were made. Concerns about foreign dominance reflected this continuation of historical practice. Most developing countries entered the post-war period as primary commodity producers and exporters, yet MNCs often controlled these sectors and their export revenues that they generated. In the aluminum industry, for example, 6 MNCs controlled 77% of the non-socialist world's bauxite output and 87% of the alumina output and 83% production of aluminum. It's in agriculture, the 15 largest MNCs controlled approximately 80% of the developing country's exports, and although FDI shifted towards manufacturing during the 60s, MNC affiliates also played an important role in these sectors. In Singapore, MNC affiliates currently account for 52% of all manufactured employment, 75% of all sales, and approximately 61% of all exports. In Malaysia, the figures are comparable: 44% manufacturing employment, 53% of sales, and 51% of exports. Although Singapore and Malaysia sit at the high end of the spectrum, MNCs also control large segments of manufacturing activity in other developing countries. Allowing foreign corporations to control critical sectors raised political and economic concerns. The central political concern was that foreign ownership of critical natural resource industries compromised the hard-won national autonomy achieved in the struggle for independence. It seemed incongruent to achieve political independence from colonial powers and yet continue to struggle under the same economic dominance that the colonial powers' multinational firms would have. Economic concerns arose as governments adopted import substitution (ISI) strategies. If MNCs were allowed to control export earnings, governments would be unable to use those resources to promote their development objectives. Moreover, if MNCs were allowed to enter the local economy freely, there would be no necessary relationship between the investments they made and the government's development goals. FDI might remain in the extractive industries, and manufacturing investments may not transfer to tech. As a result, economic activities would continue to reflect the interest of foreign actors instead of government development objectives. So hopefully you're getting that. They're saying, it's kind of explaining how in the early days, most of the MNCs, they dominated everything and they were responsible for economic activity, employment, all of that. And then as time went on, people were kind of starting to get worried, and they're like, wait a minute, I think we're kind of suspicious of that. And then they're like, why get freedom from colonial powers and then still operate under a system economically that favored that? And then as they wanted to get into all these changes, they're like, well, these MNCs are the ones benefiting off of certain things, or if you had too much MNC activity, it limited how the government could shift to some of those things. Remember the East Asian model and all of that. If you wanted to go to ISI or East Asian model to do any of that stuff, you need the government and the companies, and they were saying how the MNC stuff kind of got in the way. So continuing, in general, developing countries responded to these concerns by regulating rather than prohibiting FDI. Rather than shut themselves off completely from the potential benefits of FDI promise, governments sought to manage access to their economies to ensure that benefits were in fact delivered. Governments did block foreign investment in some sectors of the economy. For example, they prohibited MNC ownership of public utilities, iron and steel, retailing, insurance, banking, and extractive industries. When foreign firms already owned enterprises in these sectors, governments nationalized the industries through nationalization. The host country's government took control of an affiliate created by a MNC. Nationalization was common during the late 60s and the first half of the 70s. Nationalizations occurred most often in the extractive industries and in public utilities, such as power generation and telecom. Nationalizations served both political and economic objectives. Politically, governments could rally domestic support and silence domestic critics by taking over the most obvious symbols of foreign exploitation. Nationalization also made rational economic planning possible for the economy as a whole and the government's financial position sufficiently to make economic diversification and balance economic growth attainable. Governments also created regulatory regimes. Well, before, again, nationalization, we talked about this a little bit. I even brought it up on stream, but this is just the idea of the government saying, hey, we own your company now. This has even happened recently too. It's not like this is like an older day thing, but any country, if at any time, if there is a corporation, the government could say, no, we own you now and we're taking it over. That was how they kind of got all these changes through the 60s and 70s. And this is something where a lot of the developing countries during this time, they kind of have this image of being nationalized or nationalizing a lot of companies back in the day that were in their areas. So continuing, governments also created regulatory regimes to influence MNC activities. Many governments required local affiliates to be majority owned by local shareholders instead of allowing MNCs to own 100% of the affiliate. Local ownership, governments believe, would translate into local control of the affiliate's decisions. Governments also limited the amount of profits that MNC affiliates could repatriate, as well as how much affiliates were allowed to pay parent firms for tech transfers. Such measures, governments believe, would help ensure that revenues generated by MNC activity within the country remained in the country and available for local use. Governments also imposed performance requirements on local affiliates in order to promote a specific economic economic objective. If a government was trying to promote backward linkages, for example, it required the affiliate to purchase a certain number of inputs from domestic suppliers. If the government was promoting export industries, it required the affiliate to export a specific percentage of output. Some governments also required MNCs to conduct research and development inside the host country. Finally, many governments limited access of MNCs to the local capital market. All these restrictions were aimed at avoiding the downside of MNC involvement while simultaneously trying to capture the benefits that MNCs could offer. Of course, not all developing countries adopted identical regimes. Governments that pursued ISI imposed the most restrictive. India, for example, hosted a large stock of foreign investment upon achieving independence. The Indian government was determined, however, to limit the role of MNCs in the Indian economy. To achieve this goal, the government enacted restrictive policies towards new foreign investments and began to dislodge existing investments. It forced existing enterprises that owned more than 40% of the local subsidiary to either sell to Indian firms or leave India. They made exceptions only for MNCs operating in high-priority areas or using sophisticated technologies. As a result, India experienced a net capital outflow during the 70s when some MNCs, such as Coke and IBM, left and few new investments arrived. Other developing countries actively sought FDI in connection with the shift to secondary import substitution, but regulated the terms under which MNCs could invest. Because the Brazilian market was quite large, the Brazilian government could encourage foreign investment on terms that promoted domestic auto production. The government thus banned all auto imports in 1956 and forced foreign auto manufacturers to produce in Brazil in order to sell in Brazil. Imposed high domestic content requirements of MNCs. 35 to 50% of car parts had to be locally produced in 1956. And the figure was increased to 90 to 95% by the mid-60s. As a consequence, by the mid-60s, 8 foreign-controlled firms were producing cars in Brazil, and by 1980, over 1 million cars were being produced annually. Thus, even though these developing countries that welcomed NMCs sought to ensure their activity corresponded with the government's developmental goals, East Asian governments pursuing export-oriented development was far more open to FDI. Singapore and Hong Kong imposed few restrictions. To the contrary, Singapore based its entire development strategy on attracting foreign direct investment. South Korea and Taiwan were less open to investment than Singapore and Hong Kong. In both countries, the governments developed a list of industries that were open to foreign companies, but proposals to invest were not automatically approved. Each project had to meet requirements concerning local government, transfer of tech, payment of royalty in connection with tech transfer, and the impact on imports. Still, Taiwan and South Korea did more to attract foreign investment than most governments in Latin America or Africa. Beginning in the mid-60s and early 70s, both Taiwan and South Korean governments created export processing zone (EPZs) to attract investment. Export processing zones are industrial areas in which government provide land, utilities, and transportation infrastructure, and in some cases buildings to investing firms, usually at subsidized rates. Foreign firms based in EPZs are allowed to import components free of duty as long as the output is exported. Taiwan created the first export processing zone in East Asia in 1965, and South Korea created its first in 1970. The assembly and export platforms attracted a lot of investment from American, European, and Japanese MNCs. Finally, both countries liberalized foreign investment during the mid-70s in an attempt to attract high-tech firms into their local economies. Most developing countries have greatly liberalized FDI since the beginning of the 80s. Sectors previously closed to foreign investment, such as telecom and natural resources, have been open. Restrictions on 100% foreign ownership have been lifted by most countries. Restrictions on repatriation of profit have been eased. 2 factors have encouraged this liberalization. First, restrictive regimes yielded disappointing results. FDI fell during the 70s as nationalization and regulations led MNCs to seek opportunity elsewhere. MNCs that did operate in developing countries were reluctant to bring in new tech in sectors that governments had nationalized performed well below expectations. Second, the decision to liberalize FDI as part of the broader shift in the development strategies of governments intervene less in all segments of the economy, including FDI, as they shift to market-based strategies. Developing country governments have not abandoned efforts to control MNC activity. Although they have become more open to FDI, they continue to look on multinational enterprises from the vantage point of their past experiences. Much as what they welcome contribution of foreign-owned enterprises, these countries will have doubts from time to time in the long contributions of such enterprises, especially as they observe that the grand strategy of these enterprises is built on the pursuit of global sources and global markets. So, we're going to get into advanced industrialized countries, but if you're not getting what happened here. With all the developed countries and how it played out, it started with nationalization and all these restrictions, and then over time, it's literally saying, like, fast forward to today, most of them are already liberalized, and people have already gotten to realize that when you do nationalization, it doesn't create opportunity because companies stop going where they keep nationalizing it, and then the places that have had nationalism or have had industries nationalized, they have not performed as well, and then they're saying the whole trend of I'm getting the hiccups, but that is all. We'll see where next part comes in and how the advanced industrialized countries are. But Adonia, that is your watch list, ladies and gentlemen. Make sure hydrate healthy, ready to go. Make sure post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And I need you to remember, stay away from the foolishness. Don't be like the bear and robbed at the cups. Be wise. I have the hiccups for Chad. I love you. Stay in the game. Drink that water. Stay hydrated healthy. All that good stuff. I'll see you on the AMN horn.